Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing WM Technology stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. WM Technology, or Weedmaps Technology, offers a cloud-based operating system for cannabis retailers, as well as hosting a review and ratings platform for sellers, mainly in the US and Canada. You can think of this company as the Yelp for marijuana. It has over 10 million monthly active users and over 18,000 business listings. This is the #1 website for retailers looking to sell cannabis. If you want exposure into cannabis, but you're not sure which company to invest in, this is a good alternative because they don't actually grow any marijuana. They just introduce the buyer to the seller. The company charges retailers on a per-click basis, and also they sell ad space on its platform. They have a suite of services they offer to retailers to help them generate more revenue. There are over 4,000 businesses that are on their subscription service. The goal of any business is to consistently get revenue each month. A great way to do that is to offer subscriptions. The company also provides information on the cannabis plant and the industry and advocates for legalization. The Weedmaps listing marketplace provides consumers with information regarding cannabis retailers and brands, as well as the strain, pricing, and other information regarding locally available cannabis products for pickup or delivery. The only countries it generates revenue in is the US and Canada, but its platform is available in Austria, Germany, the Netherlands, Spain, and Switzerland. Recreational use of marijuana is legal in 15 US states and the District of Columbia, and over 30 US states allow some form of the drug for medicinal purposes. It is still illegal on the federal level, but that may change any day. When that does, companies like this will blow up. They get a 10, 20, 30x. WM was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In December 2020, the merger was completed and Weedmaps received $579 million in cash proceeds. The SPAC that acquired Weedmaps was SILVER SPIKE Acquisition Corp. WM is headquartered in Irvine, California, and was founded in 2008. It trades on the Nasdaq and Deutsche Borse. Let's get started with the model. This is a small cap company, 1.1 billion market cap. They're trading at $8 a share, and they have 131 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow every year. And the company is pretty much cash flow positive every year in a 12-year history, which is really impressive. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also positive in both years. Revenue is the sales for the company, and that grows from 162 million to 185 million. I don't have their full year financials. I just have the first 9 months of 2020 versus the first 9 months of 2021. But these numbers are annualized based over the first 9 months. This is their income statement. The top line is the revenue, the sales. This column is the first 9 months of 2020 versus the first 9 months of 2021. I was able to find their annual revenue for 2018, 19, and 20. They are growing every single year from 101 million to 162 million. Their revenue did go down in the US from 2019 to 2020, but it's been growing pretty aggressively in Canada from under 1 million to 12 million to 31 million. Below revenue is their operating expenses. The top one is cost of revenues. These are the expenses with web hosting, internet service costs, and credit card processing fees. And their sales and marketing have gone up from 21 million to 37 million. Because as they grow their company, they're going to want to advertise more to get more people onto their platform, both consumers and retailers. Their product development costs went up a little from 20 million to 26 million. This includes salary and benefits for employees. Examples are engineers and technical teams for building new products or improve existing ones. General and administrative went up a lot from 37 million to 70 million. This includes insurance, software costs, payroll for employees, stock-based compensation, impairments, rent, allowance for doubtful accounts, and they have about 3 million in depreciation and amortization. So you can see they do have an operating loss in 2021 versus an operating profit in 2020. In order to grow your business, sometimes you have to market more. Also, your payroll goes up. You have to find employees that have special skills, so you may have to pay them a little more. Also, the trial and error coming out with new products and new services. And the reason they had positive net income in 2021 was this positive 84 million in changes in fair value of warrant liabilities. Warrant liabilities relates to warrants that give you the right to buy common stock. And these securities are marked to market each reporting period. So they may pass through a gain or loss onto the income statement based off of how the underlying stock performs. Since the stock price is going down, they're passing through a gain on this warrant. But if the stock price goes up, then the warrants are worth more money and the company has to pass through a loss. But this is a non-cash item until the warrant expires or is exercised. And the bottom line of the income statement is their net income, which is positive in both years. But I would just focus on operating income when I look at the income statement. That's a better indicator of how the company's doing. This is their cash flow from operations section in the statement of cash flows. And the way you calculate cash flow from operations, you start with net income. That was 74 million in 2021. Then you have to add or subtract the non-cash items on the income statement. Since we pass through a gain on the income statement on the warrant, we have to minus that out on the statement of cash flows. We pass through a $23 million expense on stock-based compensation, so we have to add that back. It looks like they're extending credit to their customers. They had 6.4 million in receivables, so that's a cash negative. When they receive that money, that'll be a cash inflow, and it will improve your cash flow from operations. Prepaid expenses is when you pay for something in advance. For example, if you pay for 12-month rent up front to your landlord, you would carry that as an asset on your balance sheet and each month pass through your monthly rent expense onto your income statement. Deferred revenue is when you receive revenue up front. For example, if they charge up front for their subscriptions, if they charge 12 months up front, if somebody pays the entire 12 months, they carry that as a liability on their balance sheet. And every month the customer uses that service, they take 1 month off the balance sheet and pass through that as revenue onto their income statement. So you can see in both years they're cash flow positive. And the company did mention every year it's been cash flow positive since it started. The top part is cash flow from investing. And they spent 900,000 in property, plant, and equipment in 2020, 4.2 million in 2021. They spent 16 million of cash flow to acquire a company, or maybe multiple companies. If this was for one company, for example, that company may have asked for $20 million for the acquisition, but they could have paid 16 million in cash and 4 million in stock, because the statement of cash flows only tracks the cash. And they spent 3 million in other investments. Their reporting doesn't explain what this is. This could have been a short-term investment, so they're not sitting on cash. And this is their financing section in their statement of cash flows. They received $80 million from the business combination. Here's a breakdown of that $80 million. They received $254 million from the SPAC that acquired them. They also received $325 million from PIPE financing. This is a private investment in a public company. So if a public company needs to raise capital, they can issue shares in the open market, but that could take weeks or months. And also they have to do a lot of paperwork, they have to pay fees. It's just a big headache dealing with all these parties. Alternatively, they can find an investor with deep pockets and kind of do a side deal and say, can you buy $10 million of our stock? In order to get the deal done, the company says, since we're trading a little over $8 a share, I'll give it to you for $7.50 a share. This is pretty much how it works to get quick cash. So the investor is happy because they could turn around and sell the shares at a quick profit, or they could hold on to the shares if they want to. And the company is happy because they got their cash really quickly. And part of this $80 million, they had to pay $455 million to legacy equity holders. That may have been part of the contract. Once this company goes public, they have to pay the original investors. Of course, there's various fees, $44 million. So that comes out to $80 million. That's how we got this $80 million in business combination. And it looks like $18 million was spent to the members. I think these are the executives that started the SPAC that acquired this company. This is the equity section of their balance sheet. They have $23 million of equity. There's the Class A common stock and the Class V. If you buy the stock now, that's Class A. The original investors of the company hold Class V common stock. If the company pays a dividend, only the Class A shareholders will receive that dividend, although Class V and Class A have voting rights. And their retained earnings is $26 million. So you can see historically the company is profitable. Retained earnings is a sum of all your prior net incomes. Let's look at the capital structure. They have $23 million of equity, $46 million of debt. They're 33% equity, 67% debt. Their net debt is negative, so they could pay off all the debt with the cash on their balance sheet and still have $32 million of cash left over. I gave them the lowest WACC, the WACC according to Simply Wall Street, 6.36%, because I think the company has major growth potential, especially if the US approves marijuana on a federal level. Plus, they don't have any operational risk. They don't actually grow and sell the marijuana. That's left up to the retailers. 6.36% is a discount rate we're going to apply to the future cash flows. We estimated 6 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 6, that's $1.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.4 billion. We divide that by 131 million shares. And we get a calculated stock price of $11. They're trading at $8.26, so they're trading at a 25% discount. It's a buy according to the model. The average analyst projects their revenue to grow 31.3%. To project their future revenue, I grew at 31% for the next 6 years. And to calculate their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these two free cash flow numbers, that's 66. And I divided by these two revenue numbers. That's 347. So 66 over 347 is 7%. So I multiplied their future revenue estimates by 7%. That's how I got their future free cash flows. And they should be able to hit these future free cash flow targets. So the company does seem like it's a good value. Simply Wall Street is a lot higher than me. They're at $35 a share. They're saying it's 77% undervalued. 6 analysts priced this stock and the average price target was $17. The low was $12, the high was $21. This is where the stock has been trading since it started as a SPAC. So all SPACs start at $10. Once they announce there's an acquisition target, then the stock price usually goes up pretty quickly. As you can see here, the stock tripled, but pretty much like every other SPAC, the stock price comes down below its $10 mark. I was thinking of investing in SPACs before they acquire any companies, so I could buy it at $10, and then once they announce an acquisition, the stock usually doubles or triples, then I could sell it. And if they never acquire a company, then they have to return the funds back to me. So it's really a no-loss proposition. Let me know in the comments if you've ever tried this and if it works. They have a negative beta, which we don't see too often. That means the stock moves opposite the market. It's gone down 13% in the past 52 weeks, while the S&P is up 31%. 52-week low was $8, the high was $30, and the stock is trading well below its 50-day and 200-day moving average. In the past 10 days, 2.5 million shares have been traded on average each day. 58% of the shares are held by institutions, and over 2% of the shares are shorted. They do employ a good amount of people, 434 employees. That has gone up a little bit in the past year. If you put $10,000 into this company when it started trading, you'd be at $9,000 today. That's a 10% loss. The only insider activity was a sell by Luxor, one of its early investors, for 242,000 shares. The biggest shareholder is Silver Spike, the SPAC that acquired this company. They own 15%. Then Senvest, Luxor, Fred Alger, and Federated Hermes. Let's look at their financial ratios. They do have a really good PE, but that's only because of that big gain from that warrant liability. If it wasn't for that, they would have negative net income and we wouldn't be able to look at the PE ratio. Their price to sales is decent at 5.8. That's between the market median and average. Price to book is really high at 48. It seems like a lot of the proceeds they've been receiving, they've used to buy out the old shareholders. They have negative tangible equity since they have 54 million of intangibles on their balance sheet. They have a high current ratio and quick ratio. They have 78 million of cash on their balance sheet, 13 million of receivables, and 15 million of prepaid expenses. So they do seem to be well capitalized. They do generate positive free cash flow, and they have 68 million of working capital. So they have nearly $100 million of funding. But I know insurance costs are really high in the cannabis space, and also they're going to be looking to scale and grow. So that $100 million can go pretty quickly. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 37 companies in the same industry as MAPS. They do have a much better price to earnings and price to sales. They're not doing that good in price to book. They have a pretty weak balance sheet. They have a high current ratio, a really high ROE, mainly due to that warrant liability. They're really high in debt. For a small company, that's not too common. And they're only 1 billion market cap, which is a lot smaller than the average. To summarize, I have them trading at a 25% discount. I think this is a really safe way to get exposure into the cannabis industry, because they're not regulated like a cannabis grower. What they do is not illegal. They just provide SaaS, software as a service. They're not growing any weed, they're not selling it, distributing it, anything like that. They're just connecting the buyer to the seller. And they're the largest in this space. So if a company is looking to sell a lot of marijuana, this is the place to go. The founder of this company is a lawyer, so they stay on top of all the laws. They won't let a retailer on their website unless they're totally vetted out. So they're trying to do everything the right way so they don't get in trouble. I rank their free cash flow as 5 out of 10, their revenue 6 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.